After you've recorded your period entries in your journal, the next step is to take the numbers from that journal and transfer it to your general ledger. The journal is just a chronological record in order of what happened during the period in terms of events and transactions. The ledger is not a record of everything that happened, it's all the events or transactions that happen for each individual account. So the general ledger has a cash account in it, and in that you can look at all the times cash went up or down during the period. We call this process of transferring from journals to the individual ledger accounts posting. So to post an entry, you just take exactly what happened in the journal and move it over to the ledger. In our entry here, we had a debit to cash and a credit to common stock to record the issuance of this common stock, both for 80,000. Well, we take the $80,000 debit from the journal entry and move it to the debit column in the general ledger for cash. Has the date that occurred, has the brief description. Reference is the journal entry it was. This would be journal entry one. This is page J1 up here, so you can go and find it. And you move the $80,000 debit over. At the end of the general ledger, you will have the balance before the transaction happened. So this company had $38,000 in cash, and then the balance after the transaction happened. If they had $38,000 in cash and they got 80,000 more, they'd have 118,000 now. As for common stock, same process. Denote the date that it happened, describe a brief explanation of the event, the page in your journal that it came from, and then transfer the $80,000 credit from the journal, or post, if you will, to the $80,000 credit spot on the common stock ledger. And same thing, we had $60,000 of common stock on our books before the transaction. That just added another 80,000. Now we're up to 140 grand. And through the period, this just keeps happening and happening. Every time you use an account, you transfer what happened to it, put the date, a brief description. I usually don't have references. Some people will definitely make you put them in there, though. If they do, then it's the page of the journal that it's on. And then after you posted it, update the running balance of your account. If we had $118,000 in cash after we issued common stock and then credits to cash or a decrease to the account. We decreased our cash by $10,000 for purchasing equipment. Now it's down to 108,000. If we got another $35,000 for providing services, that debit to cash, cash always increases on the debit side, would increase our balance, bringing it up to 143,000. So on and so forth, all the way through the period. And you get to see how cash changed during the period. It's essentially just a glorified checkbook if you've ever had to balance one of those. So the ledger has an immense amount of detail, but if you're just trying to do some quick and dirty work and you don't want to put all of the things in there, you can use the simplified version, which I'm sure you're familiar with, the T account. What's the difference between a T account and a general ledger? Well, the T account only has the date that the transaction happens, will be posted off on the side, and the current balance. So there's not a running balance. You don't have the historical record of what it was at any one given point during the period. You will have a record of how, all the debits and credits that went to the account and what dates they happen on, but you only have the one balance that it would be for the entire period. Most classes that I took, at least, you would just have to do T accounts instead of having a ledger for a million different accounts. But yeah, in real practice, in most software, you will have a ledger for each and every account that you use. So now the period went through. You recorded all your entries. You had your entries posted to your ledger before you go through the process of making your financial statements, and even before that, making your adjustments. You want to make sure that you have debit credit equality. And so you prepare a trial balance for the first of three times in the accounting cycle. And its purpose is just that, to make sure your debits equal your credits. Just because your debits equal your credits on your books does not mean that your books are perfect. Still, to do your due diligence, every accountant should go through periodically and make sure that all of the stuff that has been recorded in the journal and the ledger thus far is indeed correct. Because, for example, if something happened during the period and it never got recorded, neither in the journal or transferred to the ledger, if it just never went on your books, well, it's not going to throw your debits and credits off because they would have been good before you failed to post that thing. Not putting anything in there would keep them equal. The same is true as if you record the entry and you never post it to the ledger because it's not in the ledger. It won't affect the balance that's on there, but your debits should still equal your credits. And it's also true if you accidentally post an entry twice, as long as both entries have their debits equal their credits, your overall debits and credits will still equal. If you use an incorrect account in a journal entry, it's not going to throw off your debits and credits. And if you use an incorrect dollar amount in a journal entry, it's not going to throw off your debits and credits, again, as long as they equal in the entry. So just because you have debit credit equality doesn't mean your books are perfect. That being said, if you don't have debit credit equality, I guarantee you when we get all the way through to making our balance sheet, it will not balance. And you cannot issue a balance sheet to the public that doesn't balance because it just makes you look like you don't know what you're doing. So we want to make sure before we go any further in the process that our debits equal our credits by making this guy, the unadjusted trial balance. And for Plush Service Corporation over here, they list all of the accounts that they had used thus far during the period that have a balance at this point in time. And at the end, numbers taken straight from the general ledger, the current balance at the end of the period, as of December 31st, 2025, in this case, at the end, your debits should equal your credits, and there's due 373,000, which means that this company is ready to adjust its books. We record all the things that go on during the period, but there are a few events and a few transactions that we know we need to adjust for, and they are revenues that we earned during the period for which we've not yet been paid at all. They are things like expenses that were incurred during the period for which we've not yet paid. Maybe you have a contract that you were paid for in advance and you've earned some of those revenues. You have to adjust those amounts, so on and so forth. So if you have an expense or a revenue account and that you know needs to be adjusted because something happened, even though there's not a particular, like somebody said, hey, you need to adjust this right now. You just need to know that it's going to happen because you need to do so to comply to the GAAP principles of revenue recognition and expense recognition. So we do this because all publicly traded companies need to use the accrual basis. We don't record all transactions when cash changes hands. One more time, we record revenues when they're earned and expenses when they're incurred. So what is this journal entry right down here going to be? Well, let's assume here that our company paid $72,000 for a 3-year insurance policy on July 10th, and we have coverage starting on August 1st. It's going to carry through the whole entire 3-year period for the 72 grand. That was the entry we recorded when we put it on the books. We're at the year end, December 31st. We've used some of this insurance that we paid for in advance. We've utilized it and actually incurred that expense. So what we need to do is make an adjustment that records the expense for the portion of the $72,000 that's expired and to decrease the amount of prepaid insurance we have remaining on our books. So this is on December 31st. The coverage began August 1st. How many months would we have to adjust for on this policy? And the answer to that is hidden right here, but it is 5. So now we need to figure out how much we're going to adjust for to account for the fact that 5 months of that prepaid insurance has expired. Well, first things we need to do is prorate it. We paid $72,000 for a 3-year policy, or 36 months, if you will. 72,000 divided by 36 gives you 2,000. So essentially, we're paying $2,000 a month for insurance, but we just paid for it all in advance. Well, paying $2,000 a month and we utilized 5 months of it, we get to expense $10,000 of that cost that we paid. So this adjusting entry would have a debit to insurance expense for $10,000 to increase that amount of expense. Prepaid insurance is an asset. Assets decrease on the credit side, and since it's expired, we need to decrease that account. We would credit prepaid insurance for $10,000. And then we would go and we transfer it over to our T's or our ledger or wherever to figure out what our current balance of those accounts is. We had $72,000 of prepaid insurance, 10,000 expired, and we now have $62,000 of prepaid insurance left. Depreciation is another common one that you have. It's always the same entry. You're always going to have a debit to an expense for any adjusting entry you have that is recognizing an expense because you'll be increasing it and putting it on your books because it wouldn't have been there, but you know that it was incurred. So the standard form entry for depreciation is always a debit to depreciation expense over a credit to a contra asset account called accumulated depreciation. How you find the number? Well, there's a bunch of different depreciation methodologies. You've seen some of them already in your accounting studies. You're going to see some more of them before this class ends. But for this case, let's just say that somebody used a method, any one of them, and determined that our store equipment has lost $8,000 in value. Well, we'd have to debit depreciation expense for 8,000, credit accumulated depreciation for 8,000. Another thing that we would have to adjust for is any deferred revenue we have. So where we got the cash before we actually earned the revenue. Cash first, later, or deferred revenue. And for that, we'll have an unearned revenue account somewhere that needs to be adjusted. So over here, we got that $25,000 for services that will be provided over the next 12 months. You need some way here to prorate how much of that you're going to recognize. The easiest way is just to go straight through and divide it month by month, but there are other ways to do so. Maybe you have different steps in that obligation. And to each one of those, you tie how much you're going to recognize. And then at the end, you would go and you say, okay, we completed step one, that's 5%. Step two, that's 10%. Step three, that's another 10%. That's 25% in total. We'll recognize 25% of the total amount that we received in advance. Again, there's different methodologies for how you recognize these deferred revenues that you're going to put on the books. For us, somebody somewhere used one of those methodologies and they estimated that we had earned 30% of that $25,000. Well, this again was the entry that we put it on the books with. Now, some of this isn't going to be deferred or unearned anymore. We're going to have to decrease it. So we're going to have to take this account that has a credit balance and reduce it by throwing it a debit. For how much? Well, 30% of the $25,000 original amount we got prepaid would be 7,500 bucks. So we need to decrease our unearned revenue by 7,500 bucks and increase our actually realized or service revenue by that same amount, which is why the entry is a debit to our deferred service revenue account and a credit to just good old regular service revenue for 7,500. This is still a liability. Liabilities decrease on the debit side. This is a revenue account. Revenues increase on the credit side. So this is decreasing our liability and increasing our recognized revenue in a journal entry. And now we owe them $25,000 worth of work. We just did 7,500. Now our books will show we only owe them another 17,500 on this contract. The opposite of that is instead of getting paid in advance for services we provide later, you provide the services first and you get paid later. And in this case, let's say the plush has that. We have a field technician that is indicating the services amounting to 35,000 has been provided to our customers, but we've not yet billed them for this. But we did the thing. We met the obligations of the contract that we signed to provide these services. So even though we've not billed them yet, if they told us to stop today, they still owe us that money, which means technically, according to GAAP revenue recognition principle, we have to recognize the revenues because we earned it at the time. So this would be the entry, firstly, to adjust it and put it on the books. If we have earned $35,000 of the revenues and they owe it to us, we need to change the balance of accounts receivable that reflects how much our customers owe us. That's going to increase. It's an asset. Assets increase on the debit side. So we debit accounts receivable for 35,000. And we need to increase the amount of recognized service revenue that we had during the period. Revenues, just like the last entry, increase on the credit side. So we'd have a credit to service revenue. So anytime that you provide a service to people during the period, in the process of usually something much larger on a scale, but you provide some of that service and you've not yet billed them, you still need to put the revenue on the books. This is the standard form entry for accruing revenues. Sometimes you need to accrue expenses, but it's the same basic concept. Accrued means the thing first, either the expense or the revenue, in this case, the expense, and cash later. That would be the case if you had employees that worked during the period, but the next payday is until the subsequent period. If we had employees that worked during December, but they're not getting paid for till January, we still need to put that expense on the books for the days that they worked in December on December's books. So how much do we need to adjust for? Well, their employees earn $2,000 per day, and they work 2 days at the end of December that they won't be paid for until January. How much do we owe them when December ended? 2 days at $2,000 apiece. It's $4,000. And the entry to accrue expenses is always a debit to the expense account that you need to put on the books. In this case, it's for employee salary. So we're going to debit salaries expense and a credit to the liability that you have. This entry is using salaries payable. Again, you could have a accrued expenses payable account if you wanted to, but they're all liabilities, and liabilities always increase on the credit side. They need to increase, so that's why we're going to credit that in this adjusting entry. And in general, your adjusting entries will fall underneath four categories. Deferred expenses. So that is where something was originally recorded and paid for as an asset. So purchasing equipment, purchasing buildings is usually stemming around your long-term, long-held plan assets, but you can't record the expense for the entire cost of purchasing that asset at the time that you buy it. You need to expense it periodically over time. Well, if that's the case, you're always going to have the same entry. You're going to have a debit to the expense account that's recognizing the expense and a credit to the asset or the contra asset that's tied to it of the account that you are expensing. For deferred revenue, we just talked about that one a minute ago. If you have a liability on the books for something you've been paid for originally, and then you're actually, in this case, providing the service to that you're no longer liable to have to provide to the customer. Entry for a deferred revenue is always a debit to a liability and a credit to your revenue account. If you have an accrued expense, that was just like the salaries payable that we had a minute ago. It's always a debit to an expense and a credit to a liability. And if you have an accrued revenue, that is where you get to record the revenues before the cash actually changes hands, you're going to debit an asset account, usually accounts receivable, and credit the actual revenue. Things will always fall into one of these four categories. These are the four types of adjustments. And when a situation occurs, you need to figure out what type of adjustment it's going to be and what particular accounts are going to fill in these spots over here for what needs to be your debit and what needs to be your credit. But after you've made all of your adjustments for the period, and it can be a lot of them if you're a big enough company, you want to go through again one more time, do a trial balance to make sure that your debits equal your credits after you've recorded your adjusting entries and post them to the trial or post them to your general ledger. And for us over here for Plus Services, we've done the same. We've updated the balance of all of our accounts through adjustments, but we still have our debits equal our credits, which means after we've complied with GAAP and made our adjustments, and determine that our debits equal our credits after the adjustments, we are ready to start making our financial statements.